Real Country 1430 AM and 107.3 FM WRDN. I'm Brian Winnekins from World Dairy Expo. Thank you to our expo sponsors, including Dairy Farmers of Wisconsin, AMPI, Compeer Financial, Annabis Silo, Synergy Co-op, Osteoplastics, Wisconsin Farmers Union, UtterTech, Animal Wellness Center of Buffalo Valley, and Alcivia. And joining us today is Mike North with Ever Ag. We had a chance to talk with Mike on Thursday, just after the crop report and was released by USDA. And, of course, with our midday numbers, when we did our midday market update, it was bearish, basically, for corn and beans, and not too bad for wheat. So we're going to talk with Mike a little bit about that and some of the dairy things as well. So, Mike, thanks for joining us. Corn and beans, looks like we're going to have some big changes here.
Yeah, so if you look at the numbers, USDA came out much higher than expectations. 80 million more on the corn side of things, 50 million more on the soybean side of things. And that really, as it closes up the marketing year 2020, 2021, speaks to the lack of demand in one of several categories. When you look at beans, we get a pretty good concise view of what the crush numbers are for soybeans. So quite likely you'll see some adjustments to exports as we come through this. We've all watched as China of late has been a little bit slower to the table than we would expect them this time of the year for U.S. soybeans. So that is probably the first obvious cut to the next WASDE report, which comes out the 12th of October. And then on the corn side, they were 80 million stronger, and quite likely you'd point that towards feed. Feed is always a guessing game for us because we don't have any exact reports of what's going in to livestock and poultry and how that grain is feeding out and what the rations require as a byproduct of quality or lack thereof. So it's always a little bit of a guessing game, and quarterly grain stocks reports are always a way to kind of true that up. Remember 2 reports ago, the USDA cut 100 million bushels out of feed. We came back in the last report. We added 75 million back. With the numbers today, they probably are going to have to pull that back to where they were 2 reports ago just to kind of true up the feed number. Adding stocks at this point is an interesting thing because as you head into fall, you're still asking the question of how is this crop going to yield? And we're 20% of the way through harvest. We're seeing a mixed bag of numbers on the corn side. Soybean yields have been relatively strong, especially through the drier areas, which were the biggest question marks around yield this year. And so as we go forward, implementing a higher stocks number together with what looks like pretty strong yield numbers starts to soften that discussion around price. So that's kind of the path we're on. We'll see what USDA comes back with in 2 weeks with their WASDE report. But, yeah, a negative report for sure out of the stocks numbers today.
Problem is farmers are trying to make decisions for next year. We have looks like very higher input costs for fertilizer and all that. We have higher natural gas prices and all of that. How do we take this and use it to make that decision? Because, boy, right now I'm sitting there going, oh, man, now what do I do?
Well, costs are going up, period. And I don't get excited about that. I farm too, so as I'm looking at my own input costs, it's not an exciting discussion right now. But you are watching natural gas prices on the rise. That begets a higher fertilizer price because a lot of the nitrogen production in this country sits at the end of a natural gas pipeline. And with higher prices, we're already seeing some plants idling some capacity, shutting down plants altogether. We see a trajectory of higher natural gas going forward, for the next little while. And this is not just an American issue. This is a broader global issue. We're seeing rising prices and shortages in Europe. We're watching as China's kind of holding back coal and not being willing to export that. The same with phosphates and other things that we use here in the United States. So it's going to be a very rocky road from a production ag standpoint on the grain side. As we look at $5.10 corn for these 2022, that for many people still brings them close to a break even. And so to your question, our advice to guys has been defend that. As we go forward in time, I've said this before, I'll say it again, the market's job is not to guarantee producers a profit. It's never been in play that way. It never will be in play that way. The market is trying to sort through the different forces of supply and demand and bring buyers and sellers together. That means each usually get a shot at something. And so as we talk about 2022, it's very important to defend that $5 plus corn, because if we do get a pushback from demand and we start rebuilding this balance sheet, then reality is prices can in fact go lower. So even though we don't like the cost structure involved with growing the crop for next year, that doesn't mean we should shy away from the price that's being presented to us today. Defend it and then look for better opportunities if they come along later.
Do you foresee a potential acreage war?
Yes, and that could be perpetuated further by what goes on in South America. We already know they're going to plant a lot more acres than they did last year. Early estimations are 6 to 8% more ground going into production. If, in fact, that's met with a really good production season, they're going to have a lot more beans in play that the world market is going to demand. Part of why I think China's been slow pedaling their purchase of U.S. soybeans and corn is they want to see what South America is going to do. And if you remember last year, it was that very abrupt knowledge of, hey, this corn crop's not going to be so great, that brought China into our market in an unprecedented manner. As we go into the winter, if we see big soybean production, that will likely pressure prices a little bit. And this is when, when people ask me about the acreage battle and that fight for acres between corn and soybeans, I always tell them that does not necessitate a rising market from each to accomplish it. It can be a battle of which one falls the fastest. And so as we talk about soybeans, if we get big crops from South America, that could pressure our prices and squeeze corn a little bit. And that acreage battle will kind of play out under duress, if you will. Now, flip that on its head. If we plant all these acres but we're met with a really dry season and yields are compromised, and there's some forecasts already suggesting that as we get deeper into the winter, it changes the course. And now we can talk about a rising soybean price because the world is still demanding more protein. As we've come out of COVID and economies are recovering, people are demanding more protein. And so this is an ongoing trend we've dealt with. If they come for more soybeans and there's less to find in South America, they're going to elevate the price of U.S. beans, and that will cause corn to have to fight all the more. And now these higher input prices, which we've hopefully defended with $5 corn and $12.50 bean prices, open the door for much higher soybean prices and along with it, higher corn prices.
Meanwhile, at the other end of the room, sitting by themselves at the bar, is wheat going, don't forget about us.
And they're not. If you look around the world, inflation, especially in Russia, has been a very big issue. And, to curb that, you've seen the Russian government put together a tiered tariff system on exports, which has kind of backfired on them because they thought that would mean that the farmer would just not sell into a market that opened up into export markets and channels. Really what it's translated into is farmers not selling at all. And so the price of wheat has exploded in Russia and raised the price of wheat substantially. Now keep in mind, from a stocks to use perspective, we were running about 50% stocks to use 2 years ago. We cut that with decreased acres and less production last year. Now we're, after this year, with the big reductions in yield, especially in the North Dakota, South Dakota region for hard red spring, combined with some reduced acres in hard red wheat country in the plains, we've cut that back to about 35%. What that means is we still have a really robust supply of wheat here, but the U.S. is going to be a really good outlet for world buyers to come to source wheat from because the other major provider is at a very high price. So as we look at wheat prices, they're very elevated. We're north of $7 on the wheat that we touch right here in the upper Midwest, that soft red winter. And you're seeing it even in $9 levels as we talk about hard red spring due to the drought and the lack of yield there. So wheat prices are more elevated. They will stay that way. And you will see that play out in the conversation between wheat and corn as it goes into feedlot rations in the South. There was a time as corn exploded this spring where wheat was racing in to take its place. And then as corn softened and then wheat exploded this summer, now corn has been moving back into the vacuum created by high-priced wheat. So that will have some interplay as well, corn versus wheat in the ration, and you'll see that continue to be a discussion, not so much in this area, but it does impact the balance sheet, as we talk about the entire United States, and that will touch us here indirectly.
Talking with Mike North from Ever Egg from World Dairy Expo today, and when we talked with Mike on Thursday, dairy markets, yes, we're seeing increasing supply. Cheese markets, though, have been, again, on this Thursday, they had big gains, double-digit gains in Class 3 milk. Fall seems to be the normal time when cheese will go up. So is this just that seasonal thing, and we're going to kind of ignore the increasing dairy supply, or is there more at play here?
There is a little bit more at play. You're right that this is a big demand season for us. You've just brought kids back into school, so already a month and a half ago we were seeing the bottlers start to prepare for kids standing in a lunch line looking for cartons of milk. That took some milk out of play. This is the time when we're preparing for the big fourth quarter demand. Big runs on cream cheese, butter demand at the retail level for all the cookies and the baked goods and all the things we enjoy around the holiday season. The big cheese platters we put out for the family events and company parties and all the other stuff. This is a big demand season for dairy that we're coming into, and we prep for that. So this time of the year is when we generally are pushing that into the pipeline, pulling prices up, and it's a nice seasonal push. But along with that, Brian, has been really outstanding export demand. And one thing the market's trying to wrestle with right now is where we're going to be at from a supply perspective. If you've watched very recently, New Zealand announced their August milk production numbers, and they came in well below expectation. On a milk solids basis, they were still higher, but the sheer volume of milk was less. We were not expecting that. Europe put their numbers out for August. That was also lower. Their biggest, production regions, Germany namely, and then, also England and several others, lower. This was a surprise to the market out of New Zealand, kind of an expectation out of Europe, but still it underscores the tightening milk supply around the world. And then, oh yes, by the way, in the last milk production report, we got rid of 19,000 cows here at home. We were still 1.1% over the year prior, but that was the smallest increase we'd seen all year. So we're telling a story of a shrinking milk supply, which then translates into less availability of product. We've got a lot of inventory here, but if you cut that milk supply, we'll slowly start to whittle that down. So you're seeing a compounding of strong domestic demand this time of the year. You're seeing some concerns around a shrinking milk pool as we go into winter. And then on top of that, the U.S. is in a really good spot to be competitive in the export market. And that export market, despite the port backups, despite all the logistical challenges we face, that export channel has been very robust this year, setting records as we've gone through the summer.
How do dairy farmers take advantage of this and protect all that?
Well, start off by saying that, the first half of 2022 is at historically high levels. Now, as we consider the cost of feed and we talk about those margins on the farm, the $17, near $18 price opportunities that are out there aren't going to be super profitable. But as I said a moment ago, the market's job is not to make us profitable. That's our job to do that. So when we talk about near record prices, remember that milk price is a derivative of product price. So to maintain record prices through the first half of next year when dairy demand is less and Americans have kind of stepped away from that dairy-centric diet of the fourth quarter, reality is that those higher milk prices that you see today suggest that product prices have to remain elevated. Will the consumer be willing to pay that? Probably not. So if not, that suggests lower prices are around the corner. We like using put options. We like using DRP, LGM, those products that we have in place, products that, we sell and serve out of our company, we believe are great baselines to go into that 2022 year with a floor underneath this market. Again, looking for some of these other developments to maybe give us an enhanced opportunity, and then we'll use other market tools to go after that. But right now, get a baseline underneath your milk revenue. And also be aggressively attending to your cost structures. Look at feed. A lot of that's come in. It's on the feed pad. It's probably already bought. That's probably an afterthought at this point. But, be looking at your proteins. Are you managing that as we go forward? Canada had a terrible canola crop that was echoed across the border in North Dakota. Canola is going to be short this year. What if we do get a disaster in South America? Protein prices will be on the rise. Do not get lax with what your cost structure is on the feed side. And then, let's also observe the fact that the dairy industry has become a major player in the beef space. And as we talk about the price of livestock, we've, been hovering at some pretty good territory. If you look out into winter and spring, you're looking at, $1.30 north on beef prices right now. That's translating into cow values that are pretty strong. Are you protecting those? And so these are discussions that we should be having and looking at all of the different, revenue and cost structures on the farm and making sure you're attending to them. That's how we'd go about it.
Folks like to find out more. Can they get a hold of you?
Well, real simple. You can go to our website. It's www.ever.ag. And you can find all of our contact information there. We've got people all across the country that are well-equipped to answer questions, to educate producers, and to bring them along the path to help them address some of these things.
Mike North with Ever.ag. We're at World Dairy Expo. I'm Brian Winnikins for WRDN.